Treasury yields lower this morning. We told you just a few minutes ago about the OECD cutting its U.S. growth forecast. Joining us right now is Priya Misra, fixed income portfolio manager at JPMorgan Asset Management. How low can it go?
In terms of growth or Treasury rates? Because I think
let's go with both.
Okay. So in terms of growth, I think the starting point is pretty strong. Like the economy is in a good place, was in a good place coming into all of these policy shocks. I think what we're thinking now is what's the end game? What effective tariff rate will we face? It is ultimately a consumption tax. Whether corporates eat that tax or consumers have to take it, so what's that effective tariff rate? That's what we're focused on. We're thinking 10% plus something higher on China. Maybe that's a 15% tariff. That implies lower growth, not recession. I think that recession risk has been taken off. We're thinking below potential growth. That's our base case, but a big part of that is that effective tariff rate. The other part that I'm really worried about, there's a non-linearity when it comes to uncertainty. We're living in tremendous amount of policy uncertainty, not just trade policy, fiscal policy. So at what point does that uncertainty, I think people are frozen right now. Companies are frozen. I think consumers are frozen. At what point does that uncertainty go away to allow people to start to invest, to plan those big ticket item purchases? I think that's the part.
Well, let's get a different question. Get back to the conversation we were just having in the last segment, which is you're saying that we were saying there's uncertainty. The president came out publicly and said the economy is doing spectacularly because of the tariffs. Does that make sense to you?
I struggle a little bit with that. I think there was a lot of front loading. So growth was strong because people realized we're in this tariff mode. Let's build inventories. So companies have built inventories. I think consumers bought cars. We saw evidence of that. If this uncertainty goes away July 9th or fiscal, we get something by July 4th, I think then we have the scope for the economy to do okay. If it continues, I'm a little concerned around strategic uncertainty, as Secretary Bessent has talked about. If that lasts for a while, at what point do companies start to lay off people? I think that's the labor market is strong. We're going to get a lot of labor readings this week. But at what point does it go from I'm not hiring to maybe I need to start to cut costs? I think it's really squarely about the labor market. So far, okay, though.
Okay, let's look at the 10-year and the 2-year right now. Maybe we could pick that up because I'm curious what you think is going on there. We're just at about, well, there it is. On the 10-year, we're at 4.4. You saw the 2-year, we're about, what, 3.98, I want to say? 3.918.
There's a lot going on. The Treasury market is trying to grapple with the stagflationary shock of the tariffs, plus this one big beautiful bill. What are the fiscal implications? So I like that you brought up the 2-year and the 10-year. There are different factors on both parts. I think the front end, that's why we have a lot of conviction. I think the front end of the Treasury curve is attractive because I think the market's saying the Fed is in wait and see. I think rightfully so. They're looking at risk to both sides of their mandate. But when we look at tariff, in our view, that's a price level shock. Look at inflation. We just got inflation readings last week. Inflation is heading closer to the Fed's target. If tariffs end up being just a price level shock and we don't see it in wage inflation, I think the Fed's going to cut. They'll be a little late, I think, to start. They'll want to make sure that inflation's not getting embedded in expectations and wages. Once they see that, then they're going to look at the growth impact and we think cut a lot more than is priced in. The long end is a lot trickier because there's a lot of uncertainty. You have to pay me more to price that in, which is why that curve is steepening. I think the curve can continue to steepen. The long end is a risk asset. So the 10-year, the 30-year, I think we're watching what's happening in Congress. What does this one big beautiful bill end up in terms of the deficit? Is the rest of the world still going to buy treasuries? So I'm a little nervous about the long end. I think the risks are two-sided. The front end is attractive.